In January of 2025, we invested into Cintas. Why? Well, at a first glance, Cintas looked like the most least exciting business you could possibly imagine. Its core business is just essentially renting out uniforms and picking up dirty laundry. But under the hood, this low-glamour company has become a true compounding machine. Back in 1988, Cintas made around 200 million in revenue. But today, it makes over 10 billion. This is an increase of over 50 times or around 10% average growth per year. Now, obviously, that kind of growth takes decades, and that's the point. Cintas has proven it can steadily compound earnings over the long run. A key quality feature for creating long-term shareholder value and something that we are looking for in Sifter investments. So how is this possible? What's the secret method or company feature that has allowed Cintas to compound earnings at more than 10% annually, decade after decade? But before we go into that, let's rewind to the 1920s to find the company's roots. Cintas' founders, Doc and Amelia Farmer, were rising stars in the John Robinson traveling circus, one working as an animal trainer and the other as a main trapeze artist. But then in 1921, the Great Depression hit in the United States, and they were both left without a steady work or income. To survive, Doc Farmer began collecting discarded rags that factories had been throwing away. He would then launder them and sell them back to the businesses. This small idea grew over time into dedicated washing facilities and eventually into the uniform rental business that Cintas is known for today. So what does the modern Cintas do, and why do we think that this is a great company? I will answer this question through the framework of the Sifter lens of analyzing company. That is, does the company have the ability to consistently grow over the next 5 to 10 years? Is this growth protected from head-to-head competition? And does the balance sheet and the financial position of the company support this venture? To begin, we need to explore what's the problem that Cintas aims to solve for their customers. Many companies provide standardized uniforms for their employees, so for example, nurses require fresh scrubs, mechanics require clean overalls, baristas require clean aprons, and hospitality workers need representative uniforms. These obviously need to be washed and maintained on a regular basis. But for most companies, this is a very burdensome and non-core business, as a coffee shop or an auto repair garage does not really want to run their own washing machine on premise, nor can they really outsource this to their employees. Thus, the most logical and indeed cheapest solution is to outsource the washing, the repairing and the replacement of uniforms to a third party, one who can utilize economies of scale to perform this task cheaper and more efficiently than the customer itself. So that's how we get to Cintas. That's the core business of this company. Once or twice a week, a Cintas partner will visit the customer location to replace dirty garments with freshly washed and pressed uniforms. But there is an additional twist to this story. Because the Cintas driver will visit their customers frequently, they can almost effortlessly upsell and deliver additional services. And the offering is extremely broad, ranging from anything from entryway mats to fire alarms. So I'll give a few examples. Does the customer have this kind of first aid cabinet with band-aids and earplugs? Well, Cintas can supply the cabinet and keep it stocked. Does the customer use disposable shop rags? Well, Cintas can ensure that these never run out. Are they always clean and neat mats at the entrance of a company? Well, Cintas can replace them at a weekly basis. And what about fire safety, extinguishers and alarms? Even this is something that Cintas can install and maintain. So as you can see, this list could go on forever, as Cintas has an exceptionally wide range of additional add-on services. What many of these products have in common is that they are necessities anyway. But with Cintas, they can be obtained easily as a part of an ongoing service with the same partner. Cintas is also quick to respond to changing customer needs. So for example, during the pandemic, it made sure that clients always had masks and hand sanitizer available. Now, this kind of cross-selling adds very little extra cost for Cintas, since the drivers are anyway visiting the customers on a weekly basis to replace these uniforms. So this makes this add-on service a very high margin growth opportunity. Now, speaking of growth, how does the company perform on this critical metric? Well, over the past 10 years, organic growth has averaged around 6% per year. The pandemic was, however, an exception, as you can imagine. But even then, the business continued as deliveries of masks and hand sanitizer partially offset the temporary decline. Growth for this company comes from many sources. Roughly 1% per year comes from the natural increase in the number of uniform users in the world. New customer contracts adds about another percentage point or so. In addition, Cintas has consistently raised prices above the rate of inflation, a sign of strong customer satisfaction. Alongside organic growth, the company regularly acquires smaller local competitors, further expanding its footprint nationwide. Altogether then, growth is the sum of many smaller factors, and together they explain how Cintas has achieved around 9% annual revenue growth over the past decade. So this brings us to the section of the competitive advantages, and what is the edge that allows Cintas to obtain new customer wins and consistently increase prices year after year. The answer to this lies in the company's competitive advantages. Economies of scale, operational efficiencies, and its corporate culture. The uniform rental market is very dispersed and fragmented, with the largest player being Cintas only accounting for around 20% of the total market. But being the biggest fish in this pond comes with several good benefits, the most important one being local economies of scale and network density. So let's for a second imagine a small town with only two competing operators. One is a small and local company, and the other is Cintas, which in this case has twice as many customers in the same town. Both companies have similar levels of fixed costs, but Cintas, generating double the revenue, will have better per unit economics. This means that its profits per customer is going to be much higher, which gives the company two very nice options. Cintas can either raise prices to generate even higher profits, or keep prices lower than its competitor and still making good size of profit, and thus take market share in the long run. So this is the reason why Cintas, being the largest company in this industry, has consistently taken market share over the long run. Scale also brings along other important advantages that can be used to further improve the cost structure. By data mining the large dataset of customer location, the company can save on fuel and on time by continuously optimizing their routing algorithm. The last important part of the success story is the company's internal culture. The long-standing management team has always had a laser focus on cost optimization to not waste resources. In addition, Cintas sees its delivery drivers not just as employees, but as employee partners, which are heavily incentivized to bring in additional business by upselling more services to existing customers. This kind of hustle culture of always seeking new business opportunities while looking for ways to further improve efficiencies has led to the company's current operational figures. And this is why the average Cintas employee brings in around $200,000 in revenue, while the closest competitor are only at around $150,000 revenue. As a result, then, the company can compensate their employees better than their closest peers while still generating a higher profit. Now, all of these factors combined makes the compounding machine that is Cintas today. The company is the largest company in a very fragmented end market and can therefore take market share by outcompeting on service and price. In some cases, the company can acquire the local competition outright, as this industry is still far from being too concentrated to gather attention from the regulators. Cintas has invested consistently in its own business. Its ROIC, or return on invested capital, has grown steadily and is clearly above that of its competitors. Behind this is a culture of continuous improvement, which is one of the company's greatest strengths. Then to summarize, Cintas may look ordinary on the surface, but the numbers do tell a different story. It has delivered steady earnings growth of 10% per year for decades. This has been driven by market expansion, pricing power, and new services. Its scale and recurring contracts create a strong moat that is protecting its profitability and is enabling its durable growth. And with industry-leading margins, high return on capital, and a solid balance sheet, Cintas is exactly the type of resilient, high-quality business that we want in the Sifter portfolio. This video is purely an informational video about Cintas. This is not investment advice and should not be taken as such.